Today, I'm going to tell you about a scheme which is the Government of India's very own scheme, and it's overseen by the Ministry of Finance itself, and where investors are getting a return of up to 14% per annum. Yes, I repeat, not 5 or 7%. It offers up to 14% per annum backed by government security and a guarantee, ensuring returns as high as 14% yearly. That's almost double what you get from your FD. Let's understand this scheme in detail and find out how to invest in it. I will also explain how you can become a crorepati by investing just a small amount in this. And the most important thing, what are the tax benefits? When can you withdraw? We'll discuss all the rules in detail. Let's begin. First, I need to make one very important thing clear. This is a Government of India scheme. This means we are definitely not talking about any risky scheme or fake promises. It is directly under the Government of India. The Ministry of Finance itself regulates this scheme. The Ministry of Finance itself oversees this scheme. And here you get an annual return of up to 14% per annum. Now you must be thinking, is this scheme for real? It is. Even today, a total of 13.7 lakh crore rupees remains invested in this one scheme. By how many people? There are more than 80 lakh subscribers who have invested their money in this government scheme. And there, they are making returns of 12 to 14%. If I tell you the CAGR of the last 10 years, it is more than 12%. And we'll also discuss in detail how to make it 14%. First, let's understand. If this scheme claims that it is delivering a return of up to 14%, which is of course verified data that I will also share with you, then how is this 14% return being generated? Can a bank FD give 14%? No, but this scheme is delivering that return. Understand the scheme's asset allocation. Because my team and I have analyzed it very closely. We have also personally invested our own money in it to test it. And we have also tracked its long-term track record. The asset allocation of this scheme is very simple. If you invest 100 rupees in it, or 1000, or maybe 10 lakh, your investment money then gets bifurcated or divided into 3 to 4 separate parts. The first part, 75% of your total investment, meaning if I invest 100 rupees, then 75 rupees, goes into the equity market and not into any small company. BSE 100 or Nifty 500. That is India's top 100 and top 500 companies listed on the exchanges. Basically, Reliance, Tata and Airtel. Our money is invested in all these major big companies, which gives us stability. Second, 15% of the capital. Out of the 100 rupees we invested, 15 rupees are invested in corporate bonds. Here, we invest in only AAA rated instruments, not risky corporate bonds or bonds of small companies. These AAA rated bonds, featuring sovereign backing or from giant corporations, are vehicles, from where a good return can be earned. Third, 8% of the portion is invested in government securities. This capital is invested into bonds issued by the RBI or central government. And the remaining 2% is in alternative investments, apart from equity and bonds, such as REITs, real estate investment trusts, where you can invest as little as 500 rupees and your money is invested in large real estate properties like a luxurious mall, hotels, or large corporate parks, and the rental income of lakhs and crores that comes from there. That can also be your profit. I've also made a separate video on this specific topic, which has more than 2 lakh total views. The link's in the description for you to check. If you want, you can also invest in listed rates and InvITs. Here you can earn returns of 8, 10, 12, or even 15%. I detailed this in the video and included the link down in the description. This fund takes your total 100 rupees and allocates 2 rupees there too. This action ensures your entire portfolio becomes properly diversified. So, what is the main benefit of this diversified portfolio? These returns we discussed. See, in the equity market, returns are typically a bit higher than elsewhere. In the bond market and government securities, you get stability. And in rates and InvITs, you actually get to have regular income. Now, the key point. Every person's risk appetite is different. If there's a 20-year-old person or a 40-year-old person who is investing money in this scheme, both of their risk appetites will be different. Why? Because their ages are different and their family responsibilities are different. That's why the government has created a structure through which you yourself, if you want, can divide it according to your preference. You can decide for yourself how much money you want to allocate to equity and how much you want to allocate to bonds and government securities. You can decide. There are 3 options here. See, the very first one is the moderate life cycle option. This effectively means it is for those people who do not want to take much risk. For them, 50% of the money, if their age is less than 35 years and they are investing in this scheme, 50% of their money will go into equity. 30% will go into corporate bonds and 20% will go into government securities. But if there are people like me who want an aggressive life cycle, who want the fund to work aggressively, take more allocation in equity, and generate higher returns, then for them, you can allocate 75% of the money to equity, 10% into corporate bonds, with 15% going into government securities. For the conservative life cycle investor who avoids all risk, only 25% of the total capital will go into equity, 45% in corporate bonds, and 30% in government securities. Now, there is another interesting thing in this fund, which the government has made for your and my safety and security. This feature states that as your age increases, your risk appetite actually starts to naturally decrease. Therefore, as your age increases, if you carefully notice, the equity allocation is gradually decreasing and the allocation to bonds and government securities is increasing. Why? Because with age, we want to take less risk. So to address this specific need, a special kind of fund has been created which automatically tracks your risk appetite according to your age and then smartly manages the allocation between equity and debt. It manages the allocation. This fund is ideal because unlike other mutual funds, it balances equity risk according to your age. Also, one may wonder if this fund truly gives returns of 12 or 14%. The answer is yes. In India, the Ministry of Finance has actually given the final approval for a total of 8 approved fund managers. Now, who are these 8 big fund managers? The names are on your screen. Max Life, Aditya Birla, Kotak Pension, UTI Retirement, LIC, ICICI, HDFC, and SBI Pension. These are the 8 funds that manage these funds. Meaning, if you invest 1 lakh, 10 lakh, or 50 lakh, whatever you invest, these fund managers manage your money. If you were to look at their track record from the last 10 years, because my team and I have personally tracked it, we have done complete research on which fund manager is the best. I'll explain how to invest later. See, the SBI pension fund is the best. In the last 10 years, it delivered CAGR of 14.2%. Now, we all trust SBI. It is a public sector undertaking, a government entity. There are no chances of losing money there. And the most important thing is, here, it is not SBI holding your money. SBI has basically managed a fund for investors and there are trustees who take care of your money. Don't think you've given a loan to SBI. If you prefer that, you can simply go to an SBI bank and open an FD. But you only earn 6 to 7%. Now, if you were to invest in the same SBI managed fund, you will get a return of 14.2%. I'll explain how to invest. Don't just go and line up in front of SBI just yet. Next, the HDFC Pension Fund, a second top-rated manager, shows a CAGR of 13.8%. So, you should understand one thing. Here, you are putting your money in an investment option regulated by the government, that is, the Ministry of Finance. On top of that, these fund managers that you are seeing are not small but major players, including SBI, HDFC, and ICICI. And LIC is also a top fund manager. They will not lose your money because they have years of experience. If you look at these 4 top fund managers' performance, which is from the last 10 years, it's 13 to 14%, while SBI yields 14.2% CAGR. Can you imagine this? Today, when we make FDs in banks like SBI, HDFC, or ICICI, we get a return of 6 to 7%. Even if you go to the post office and invest there, if you are a senior citizen, even then you get a maximum return of about 8 to 8.5%. These funds deliver a 13 to 14% CAGR. Plus, these funds operate under the Indian government and the Ministry of Finance. What this fund is, how to invest, I will explain it all. First, understand how this government scheme, this fund, generates a return of 14%. Because everyone has this doubt, wondering where 14% comes from when banks or post offices only offer 6 to 8%. Specifically, what happens is that out of your invested money, 75% is invested in the equity market. But it's not risky. Why? Because it's invested in top 1 in 500 companies listed on the NSE and BSE, such as Reliance, HDFC, SBI, ICICI, and other similar large cap companies. So as the equity market performs, you are going to get the benefits. For 2016, 17, and 18, I have made a complete chart. You can see 2 bars here. One is the blue bar, which represents FD returns. FDs typically offer 6 to 7%. While they formerly returned 7 to 8%, the current average is 6 to 7%. And these orange bars are the returns of this scheme. Let me explain. In 2016, the market underperformed a bit. Equity markets underperformed a bit. So, in 2016, it returned 4%. FD would have given you 6 to 7%. But in 2017, this fund gave a return of almost 17 to 18%. Average returns increased overall. Take 2018, 19, and 20. There were only 2 years, 16 and 18, where this specific fund failed to beat the FD. Besides those 2, examine the 10-year record as in each year. This fund has outperformed FD returns, meaning it's much more than your 6 to 7% FD. In some years, it has delivered 3 times the return, and in 2021, this fund gave a return of almost 22%. FD gave 6%, this gave 22, roughly 4 times more. This averages out your returns in the long term, making 12 to 14% easily achievable for you. Now, remember one thing. You don't have to pay tax on your capital growth here. What does this mean? Look, let's say I invested 10 lakh rupees today. In its first year, this fund gave 15%. So, on 10 lakhs, I would make a profit of 1.5 to 2 lakhs, whatever, 15 or 20% return it gives. But I won't be taxed. Why? Because the money keeps growing there. I won't withdraw. The following year, the fund generated a 20% return. Again, I will make 2 to 2.5 lakhs profit tax free. This benefit lasts. Until you redeem, until you withdraw, the money keeps growing there. Your returns for each year will also keep getting added to it, without any taxation. Okay, a very important thing. Now you'll say that, of course, these fund managers must be managing this fund, so they must be charging us for it as well. Absolutely not. These people only charge a fee of 0.09%, which is really quite low when compared to regular mutual funds. You can check the expense ratio of any mutual fund on Google. The mutual fund in which you are doing an SIP in which you are investing, which includes funds like the SBI, Parag Parik, or HDFC fund. Verify the expense ratio of any equity fund on Google. It is 1 to 2.5%. This means if you are investing 1 lakh rupees, then that fund is deducting 1 to 1,500 or 2,000 from your invested corpus every year as a fund management fee or expense ratio. But here, if you invest the same 1 lakh rupees, it's only deducting a measly sum of 0.09%, which is hardly 90 rupees. That's it. This is certainly the lowest fee. There probably isn't any other fund in the whole of India that operates on such a remarkably low fee. And I'm telling you, the lower the fee you pay, the more your capital grows. If you just enter it in a mutual fund calculator, calculate an SIP of 2,000 for 30 years on the calculator. If you invest 2,000 rupees, how much amount will you get at a 15% return? That creates a 1.4 crore corpus. If, instead of 15, if your expense ratio is 2%, your return is only 13%. Then that difference will be in lakhs. Meaning, you should understand one thing. The lower the expense ratio you pay, the more your capital grows. That's a clear fact. And this is not something that needs to be explained. Anyone with common sense can understand this. But this scheme is also fulfilling that purpose. Because the government wants your money to grow. The government doesn't want to earn. The government is not running this scheme for profit. It runs for the benefit of Indians, ensuring your future and retirement are safe, so you can build a large corpus of lakhs or crores. This ensures a comfortable retirement and an annual pension income. I will explain that shortly. Now look, why is this scheme safe? Because people think that even though it's a government scheme, even if the Ministry of Finance regulates it, the money enters the equity market. Is this scheme truly safe? Yes, since it comes under the Ministry of Finance, which is directly under the Government of India. This is not a private entity scheme where they will take risks and do anything. No. The government also ensures that we adjust allocations based on your specific risk appetite. Second thing is PFRDA regulation, the Pension Fund Regulatory and Development Authority established in India, which maintains oversight for this fund. Meaning, fund managers like SBI or HDFC cannot change investment allocations based on their own personal whims. They cannot opt out of large companies to gamble on small cap stocks. Such actions are strictly forbidden for them. Why? Because it is stipulated in the PFRDA regulations where fund managers can invest money, and they are required to follow those regulations. Getting my point? Third, there is a trust structure. The money doesn't go directly to SBI but to their fund, which will have a designated trustee. Whom? The Ministry of Finance and PFRDA, that is, the Pension Fund Regulatory and Development Authority, themselves ensure that your money is being invested safely and correctly, and invested in your name. Plus, 8 approved fund managers alone can run this scheme. You are not giving money to any unregulated person. All 8 names I mentioned are big fund managers. The chances of losing money are very low. Consider the math. Can you really become a crorepati by investing a small amount? Yes, you can. See, think of it this way. Today your age is 25. Let's say you are 25 today, and now you want to plan for your retirement. So that when I turn 60, I have a large corpus created. So that I can retire comfortably and enjoy the rest of my life. Correct? If you are investing 2,000 rupees per month, you are investing only 2,000 rupees per month through an SIP. And from when? From the age of 25. Continue this SIP for 35 years and your total investment will be 8.4 lakh rupees, which is 8,40,000 rupees. How much will you get? You will get 1.21 crore rupees when you retire. This calculation uses only 12%. I didn't use 13 or 14%. If I were to calculate it higher, then the amount will be very large. Very importantly, your capital has multiplied by 14.4 times. This means the 8,40,000 you invested has grown 14.4 times, which brings your total corpus to 1.21 crore. These are outstanding returns. You can see this growth in the graphs, a curve of exponential growth. This means your growth, the growth of your capital, is accelerating. This is happening because your money is compounding here. Getting my point? Okay, now I'll explain a simple example. Not everyone among you is doing an SIP of 1000. Some may want to do 2000, some 5000, and some 10,000. So I have done some calculations for you. If you invest 1000 rupees per month, starting from age of 25 until you're 60, you'll make corpus of 0.60 crore, which is 60 lakhs. For a 2000 rupee SIP, you will build a corpus of 1.21 crore. Invest 5000 monthly. If you do an SIP of 5000 rupees per month in this fund, you will create a corpus of about 3 crore rupees by the age of 60. And if you can invest 10,000 rupees, you can create a corpus of 6 crores. Can you imagine this? This retirement fund is a true blessing, a blessing that ensures you can go on a world tour after retirement. If you invest 6 crore rupees in a good fund, I will tell you later, even if you get a 12% return, you can't imagine how much money you can earn. Just imagine, with 6 crore rupees, you can generate an income of 6 lakh rupees every month. At 12%, you need an SWP. I will explain that later. So it's a very amazing option. That means if you start from now and invest your money with safety and security, and don't invest in random trading and investing, you can build a very large corpus. This plan comes with excellent features, like starting with only 500 rupees. And second, it provides a benefit for those following the old tax regime, because even though the new tax regime has arrived, you may still prefer the old one. And you get the benefit of both Section 80C and Section 80CCD, which is 2 lakh rupees per year. This means that if you invest 2 lakh rupees from your total taxable income here, you won't have to pay tax on it. For this, you can consult your CA once more. If you want, you can also withdraw the money earlier. There are 2 options in this. I'll tell you about this as well. Although this is a long-term investment option from the government, which is for your retirement planning, generally, at the age of 60, this scheme matures and you get whatever corpus has been accumulated. But there are 2 things in this. Whenever you reach retirement age and you say, my corpus of 5 crores is now created, please give it to me. The government will give you 2 options. The government will say, a minimum of 40% has to be taken in the form of an annuity. That is, the government will give you a monthly pension from it. And the remainder you can take as a lump sum payment. I will show the math later. More importantly, if you need money before retirement, after 5 or 10 years, partial withdrawals are allowed. Partial withdrawals are allowed after 3 years for emergencies. The returns are fantastic. You gain excellent long-term growth, reaching 10, 12, or 14%. I have already demonstrated the performance data for the past 10 years to you. Now it's up to you where and how you want to invest. Now, what is this government scheme? See, this scheme was launched in 2004 by the Government of India. At that time, it was only for government employees. Then in 2009, the government opened the scheme to everyone, allowing any person to invest. This is a long-term, voluntary retirement savings scheme. Okay? A voluntary retirement savings scheme designed for systematic saving while you are working. Now, when you retire, you will get the money. And who manages it? The Pension Fund Regulatory and Development Authority, which comes under the Ministry of Finance, under the Government of India. Okay, although it was launched in 2004, people have been investing in it since then. Today, its AUM is 13.7 lakh crore, surpassing assets managed by many mutual fund companies. More than 80 lakh people are investing in this single scheme. The average CAGR for the last 10 years is above 12%. Now, there are 2 investment options, Tier 1 and Tier 2. What is Tier 1? This is a retirement account. Meaning, if you invest any money in a Tier 1 account, which you will continue to invest every month, you can only get this money at retirement, as it's locked in until you turn 60. However, partial withdrawals are allowed for emergencies. But otherwise, you will get this money when you turn 60. Plus, this offers tax benefits too. But a Tier 2 account is one that works like a savings account, with no lock-in period. See, very important, there is no lock-in. There is flexible withdrawal here. There are no tax benefits either. Like any mutual fund, you can continue your SIP and keep investing for as long as you wish. When you need the money, just request a withdrawal and it gets processed. But yes, one advantage is that you get some government oversight because, of course, the Ministry of Finance will be managing this scheme. So they will make sure that your money is not lost. Let's examine how the structure functions. This scheme is the National Pension Scheme. And this scheme is applicable to all citizens of India, in which you invest money for the long term, and you get a guarantee or security of a pension for the future, for after retirement. Now, how to invest in it? See, anyone like you or me can invest in it. Okay, you can set up a fixed monthly contribution that's automatically deducted from your account and invested here. Its regulator is PFRDA, which I have already told you. There is an NPS trust that safeguards your money. Government-approved fund managers oversee your money, which is invested into the capital market, including both equity and the bond market. Tier 1 and Tier 2 are 2 different accounts through which you can invest in it. The triple tax advantage in this is under the old scheme. There is no such tax advantage in the new scheme now. Tier 1 subscribers used to get a tax deduction up to 1.5 lakhs under Section 80C. Under Section 80CCD, you gained an extra 50,000 deduction, meaning if you invested 2 lakh rupees a year from taxable income, you wouldn't have to pay tax on it. Moreover, the money you received at maturity, 60% of that money, which you get as a lump sum at maturity, that also becomes tax-free. But there is no such benefit in the new scheme. Now let's do a comparison. Is it really right to invest in this scheme? Or is it more beneficial to invest in other government schemes? Look, the return in this scheme is 10 to 14%. I have explained its entire background to you. If you invest in PPF, you get 7.1%. ELSS returns are 12 to 18% with a 3-year lock-in. And under the old tax regime, there were benefits, but not in the new one. A bank FD only gets you 6.5 to 7.5%. Okay, let us examine the withdrawal rules. This is quite important. If you need the money, first, you can get the full amount at maturity. But how does that happen? Your retirement corpus will be ready. You can withdraw 60% as a lump sum. For example, I invested money every month and now at retirement, my corpus of 5 crore rupees has been created. 60% of this 5 crore corpus, 3 crore rupees, I will get at once. Now I can do whatever I want with it. The remaining 2 crore rupees will provide me with a monthly pension. With this 40%, I must purchase a monthly annuity with it, which I can get from a good company where I will keep getting a fixed return of 7 to 8%. And I will keep getting it every month as a pension. If I pass away, my family will keep receiving that pension money. Partial withdrawal is allowed after 3 years. But there are some specific purposes mentioned by the government for which it is allowed. I have put all the details in the description. Okay. Then, premature exit. If you want to withdraw before the age of 60, you may withdraw 40% as taxable lump sum, while the remaining 60% must be taken as an annuity. Yes, after the age of 75, after you turn 75, you are able to withdraw the complete 100% amount as a lump sum with no annuity obligation. Simple as that. Now the question is, should I invest? If you're thinking so, there are two things. If you are between 20 and 40 and want a long-term investment, this is right for you. But if your current age is already over 50, then this particular scheme is really not appropriate for you. It is far better for you to invest directly in corporate bonds. If you have 10, 20 or 50 lakh and you want a fixed monthly income on it, then investing in corporate bonds is a very good solution, because if you invest 10 lakh rupees today and they offer a 12% return, then I can expect a 12% return regularly. I can select monthly interest bonds. What results from this? I invested 10 lakh rupees. For example, if it says that I will pay you 1% monthly, that's 12% annually, yielding 1% per month. In that case, I will get an interest of almost 10,000 rupees every month on my 10 lakh rupees. Likewise, investing 50 lakh rupees in bonds yields 50,000 rupees every month, creating a steady stream of passive income for me, where I don't have to do any work. I have put my money to work. Second thing, for salaried employees, they can get tax benefits under the old tax regime, not under the new one. If there are other investors like me who don't have a salary income, it is unsuitable, but I am still able to invest for the long term. Self-employed people who will not receive any pension money, like me, or my video editors, or people like them. Or there are some people who are self-employed for whom there is no pension scheme, because absolutely no company is going to give them a pension, so they can invest here. This scheme is not for retirees. For them, as I mentioned, corporate bonds are a very good option. Now those who want to take less risk and want an allocation between equity and debt, this scheme is the best for them. Because whenever you invest money, many of you might be doing an SIP of 2, 3 or 5,000 in an equity mutual fund. All your money is going to the equity side. Market dips cause losses in pure equity, but this scheme offers a protective benefit instead. Since it splits your money between equity and debt, you get a built-in safety net. And if you are planning for a long-term, structured retirement, then this scheme is the best for you. But this should mostly be considered by people who want to invest some money monthly, who are young. If you want to save or invest some money every month, this is the best. If you want a lump sum investment without market risk and with safety, then you can simply download the Stable Money app, go to the bond section, and you will start earning returns there. For your most important question, how exactly do you start investing in this scheme? It is a very simple 3-step process, and you need to obtain APRAN, which is a number. How to do it? You have to go to enps.nsdl.com. Your bank, Aadhaar, and PAN card are essential. Once you submit these, registration completes quickly. Then, you just need to choose your fund manager and the investment scheme. You can select the fund manager yourself. Look at the track records of past fund managers. I have already told you that SBI, HDFC, and ICICI are performing very well. You can select them. How should you keep your allocation? Should it be auto choice, where it changes on its own with age? Or would you prefer manual control, like putting 70% of your money into equity and the rest in corporate and government bonds? You can decide that manually as well. Lastly, you have to select the monthly SIP amount. For example, 500, 1000 or 2000 rupees. You can select it. Once you do this, your money is automatically deducted and invested. They also have a separate mobile application available where you can easily track all your investments on a live basis. If you need to request a withdrawal, do it there. The scheme is called National Pension System. Key takeaways are on the screen, which I have already explained to you. If you enjoyed the video, please like it and subscribe for more such insightful videos.